Welcome to the deep dive. Today, we're diving straight into a really fascinating area. It's becoming super crucial for anyone thinking about their financial future, really.
Yeah,
How artificial intelligence is changing the world of pensions. You asked for a clear, quick understanding of this, significant trend, and that's what we're aiming for today.
absolutely. And to really get to the heart of it, we've been looking at this very detailed report, Pensions in the Age of Artificial Intelligence.
Okay.
It's a really substantial piece of work. I mean, it even qualifies for professional learning credits with the CFA Institute.
Wow. Okay.
So that tells you something about its credibility
Yeah.
and its depth.
Okay, let's unpack why this matters right now.
Yeah.
Globally, pensions are just huge. We're talking over $55.7 trillion across just 22 major economies.
Mm-hmm.
That's about 69% of their total GDP. But this massive system, it's facing some really significant pressures.
That's right. The report, it really pinpoints some key challenges. We're living longer, birth rates are declining,
Yeah.
and this is putting a huge strain on government-backed retirement systems.
And it's not just about how long we're living, is it? We're also seeing this widening economic inequality around the world. I mean, the number of people in extreme poverty is staggering.
It is. Plus, the whole way we save for retirement has fundamentally shifted.
Exactly. We've largely moved away from defined benefit or DB plans, where our employers promised a set income and handled the risk.
Right, the Gold Watch retirement idea.
Sort of, yeah. And we've moved towards defined contribution or DC plans where individuals, well, they shoulder a lot more of that responsibility and the risk.
Okay, now here's where it gets really interesting.
And
Because even those older DB plans, they aren't immune to challenges.
no,
The report mentions underfunding in U.S. public companies, a pretty significant deficit in 2023, actually. Now, it's important, right, to distinguish this from pay-as-you-go systems.
yes, very important. PAYG is where current workers' contributions fund current retirees. Those are different. And those PAG systems are particularly vulnerable to the demographic shifts we just talked about.
Extremely vulnerable. And this shift towards DC plans, well, it gives individuals more control, sure, but it introduces new problems,
Like what?
particularly the risk of retirement income just falling short.
Mm.
The report suggests that traditional investment mixes, like the 60/40 portfolio,
Yeah, the classic.
might just not be sufficient anymore in some countries.
Yeah.
Think the US, Australia, and there are real questions about whether current contribution levels in places like the UK will be enough for many people either.
Then you throw inflation into the mix.
Ugh, inflation.
Even if your investments make nominal gains, high inflation can just eat away the real value, the purchasing power.
Absolutely. That example in the report, 5% inflation over 15 years, potentially having the real value of a fixed DB benefit that really hits home.
It really does. It shows how insidious inflation can be.
Precisely. And pensions are also tied up in this broader issue of rising inequality. They can reflect existing disparities and maybe even contribute to them sometimes through how benefits are distributed.
So, with individuals now effectively acting as their own chief investment officer in these DC plans, how equipped are they really? The report touches on financial literacy.
Or the lack thereof sometimes.
Yeah, and the information gaps that exist. People are increasingly making really complex investment decisions for themselves.
And this complexity is driving demand for, more personalized experiences, financial wellness programs,
What does that mean exactly?
things like tools for budgeting, saving, investing advice. And increasingly, people expect plans to consider things like diversity, equity, inclusion, too.
Right.
The challenge is offering that personalization without just overwhelming people with too many choices. It's a tricky balance.
Okay. So we've painted a picture of the challenges. A bit grim, maybe.
Oh, realistic, perhaps.
Fair enough. Now, how does AI fit into this? What exactly is AI in this context, and why is it seen as a potential game changer for these pension issues?
Okay, so at its core, AI is about using computers for tasks that normally need human intelligence. Machine learning, ML, is a subset of AI where systems learn from data to get better over time, automatically.
And we hear a lot about generative AI now.
Exactly. Gen AI, things like ChatGPT, or even finance-specific ones like Bloomberg GPT. That's really exploding and opening up new possibilities everywhere, including finance. Definitely including finance.
So the big promise here is that AI can bring more personalization, make things run smoother, more efficiently, and improve accuracy across the whole pension process.
That's the potential, absolutely, from how plans are designed right through to how people actually get their payouts.
But are pension funds actually using it much yet?
Well, the report points out that many pension organizations are still in the very early stages. Quite early. Yeah, and interestingly, it seems actuaries in pensions are currently less likely to use AI and ML compared to actuaries in, say, insurance. And when they do use it, it's often for more basic stuff like data collection, basic analysis.
But it is starting to be integrated in some key areas, right? The report mentioned a framework, Invesco, was it? 4
That's right,
categories.
Invesco's framework. Plan design, participant engagement, plan governance, and investment strategy.
Okay, can you give us a quick example for each? Make it concrete.
Sure. Plan design. AI could analyze employee data to suggest maybe better employer matching contributions, more tailored
Okay.
engagement. We're already seeing chatbots answering member questions, reducing call center load.
Right.
Governance. AI could help trustees get a clearer picture of all their members' diverse needs.
Makes sense.
And investment strategy. AI could help tailor investment options more closely to individual circumstances beyond just age.
And drilling down into investment management itself. The CFA Institute report said the main uses right now are analyzing business data and managing risk.
Yes, that's what they found. Initially, it seems a lot of the benefit is about automation saving staff time on routine tasks and just getting better, deeper insights from the data they already have.
Okay.
So to really grasp where AI can make the biggest difference, it's useful to break down the whole pension process itself. The World Bank Group outlines 5 key stages in the pension value chain.
Okay, what are those 5 stages? The whole journey.
Right. First, membership and payment channels, how people join and pay in. Second, record keeping and account management. Third, governance and investment strategy, the oversight and planning. Fourth, the actual investment management.
Yeah.
And finally, fifth, the payout phase, when people start taking money out.
And these apply to both DB and DC plans.
They do, but the specifics look quite different for each type, as you'd expect.
Okay, let's drill down into those differences. Start with defined benefit plans. How do those 5 stages play out there?
Sure. In DB, membership is usually automatic, tied to your job. Record keeping can be simpler because the benefit is often based on a formula salary, years of service.
Not individual pots of money.
Exactly. Governance is mainly the trustee's job. They decide the long-term investment strategy, make sure it's funded properly. Investment management is often outsourced. And the payout phase relies heavily on actuarial analysis to ensure the money's there to meet promises decades down the line.
Okay. And how does that compare to the defined contribution journey?
Well, with DC, individuals often have to actively choose their investments from a menu the plan offers.
Right, you get that list of funds.
Yeah. So record keeping is much more complex, tracking individual accounts, investment choices, balances. Governance involves the sponsor or trustees making sure the investment options offered are suitable. Individuals usually have more direct control over their own investment strategy.
And the payout phase.
That's also largely member-driven. They decide how and when to withdraw funds, and they bear the longevity risk, the risk of outliving their savings.
All right, got it. Now let's loop back through those stages and see where AI is starting to make a real impact. Let's start with that first one, membership and payment channels.
Okay, so onboarding new members. AI can streamline this. Think interactive platforms collecting data more efficiently. AI spotting missing info automatically.
Less paperwork, hopefully.
Hopefully. And AI can also help clean and organize all that data. It can even analyze existing pension documents, like contracts, to pull out key info and improve accuracy. Good data is crucial for everything that follows.
Makes sense. What about keeping members engaged after they've joined?
Yeah, big area. Pension dashboards, we're seeing these pop up in various countries, can use AI to help match individuals with all their different pension pots from previous jobs.
Ah, that would be useful.
Definitely give people a complete picture. And chatbots are getting smarter. Principal Financial Group used one to cut call center volume significantly. Smart Pension has one, SE, that works in multiple languages.
And the report mentioned analyzing member feelings. How does that work?
Yeah, sentiment analysis. Using natural language processing, NLP, to analyze feedback from surveys, emails, calls. It helps providers understand member attitudes towards ESG investing, maybe, or annuities, or just the service they're getting. This allows for much more tailored communication and support.
And the nuts and bolts, the actual payment systems.
Yeah, AI's helping there too. The focus is on smoother, more automated systems for contributions coming in and benefits going out.
So efficiency and security.
Exactly. Benefits for employers and for members too. Things like automatic contributions from payroll, faster access to funds in retirement. The report even suggests digital payment systems, powered by AI, could be key to expanding pension access in developing markets, like in Africa.
Interesting. Okay, moving to the next stage, record keeping and account management. This seems like prime territory for AI automation.
Absolutely. Keeping member data accurate and up-to-date is a massive task. AI can help consolidate data from different sources, different formats,
Like merging records.
yeah, and spotting errors. Gallagher used AI for DB plans to identify data errors. This is vital for data integrity, obviously, but also for things like integrating with the UK's pension dashboard or when facilitating pension risk transfers between providers.
And just the day-to-day processing.
Automation helps hugely there. Processing contributions, investment transactions, reconciling accounts, handling claims. Smart Pension talked about how automation significantly cuts errors and operational costs.
And it's not just the pension funds using these tools, is it? Regulators, too.
That's right. Pension supervisory authorities are starting to use AI to help them collect and analyze regulatory data more efficiently.
And reporting back to members.
Yeah, the report stresses how important clear, accessible reporting is. The UK pensions regulator has guidelines on this, and AI can help personalize it. LifeSight by W2W, for example, uses AI for personalized benefit statements and even sends automated nudges to members.
Helpful reminders, maybe.
Exactly, like suggesting they increase contributions or review their investment choices.
Okay, let's dig into governance and investment strategy. This feels weightier, more strategic, maybe harder for AI to crack.
It is more complex, certainly,
Hmm.
but AI can still enhance decision-making. It can give trustees and sponsors a much richer, more comprehensive view of their members' needs and circumstances.
How so?
By analyzing aggregated, anonymized data, for instance. For DB plans specifically, AI can sift through mountains of plan documents, legal texts, actuarial reports, and highlight key information for trustee review.
But transparency is key here, right? You need to know why the AI is suggesting something.
Absolutely crucial. The report really emphasizes the need for explainable AI, transparent AI, and human expertise has to remain central. AI is a tool to augment judgment, not replace it.
That case study about Endapt using Discover AI, analyzing the employer's financial strength for a DB plan, that seemed quite powerful.
It did. The covenant assessment. AI allows for much more frequent monitoring, quicker access to information about the sponsoring employer's ability to support the plan.
So spotting potential problems earlier.
Exactly. More timely interventions. AI is also creeping into board management tasks, automating things like meeting minutes, summarizing reports. Again, though, human oversight and professional input remain critical.
The idea of AI as a potential non-voting trustee agent was interesting, like an early warning system.
Kind of, yeah. Flagging potential issues based on data analysis. It's a thought-provoking concept.
Okay, what about setting the actual investment strategy for DB and DC?
For DB plans, it's about complex asset liability modeling, stress testing, refining assumptions about inflation, longevity. AI can help crunch those numbers and explore more scenarios.
And for DC, where members have more choice.
There, the fiduciary duty is often about providing an appropriate range of investment options. Target date funds, or TDFs, are popular defaults.
The ones that adjust automatically as you get older.
Right, but they're often criticized as one-size-fits-all. AI could potentially help design more nuanced default options by analyzing member characteristics beyond just age, maybe risk tolerance, other savings.
Capturing more individuality.
Exactly. And we're even seeing AI agents, these sophisticated GPT models, being used to automate workflows, like gathering and summarizing economic forecasts, market news.
So faster insights for the investment team.
Potentially, yes. Getting timely data is crucial. The report definitely recommends that asset owners start experimenting with these AI tools, carefully, of course.
Okay, let's shift slightly to manager selection and maintenance, another governance function.
Yes, a critical one. The CFA Institute's Code of Conduct for Pension Trustees emphasizes the need to regularly review the performance and practices of the asset managers they hire.
So how can AI help with choosing and monitoring fund managers?
Well, it has the potential to bring more analytical rigor, more accuracy to performance reviews, looking beyond just the headline returns.
Like digging into how they achieved those returns.
Exactly. That case study about Japan's GPIF, the world's largest pension fund, using AI research with Sony CSL. They're trying to analyze fund manager behavior patterns from trading data
To find what?
to potentially identify managers who exhibit characteristics associated with skill rather than just luck, maybe identifying truly superior active managers. It's cutting-edge stuff.
Fascinating. And then there's stewardship. What exactly is that in this context?
Stewardship is about pension funds acting as responsible, long-term owners of the assets they invest in. using their influence, things like voting at company meetings, engaging with management to protect and enhance the value of those investments over the long haul.
So pushing companies on ESG issues, for example.
That's a big part of it, yes. Environmental, social, and governance factors. The Brunel Pension Partnership example, using EOS at Federated Hermes to help guide their voting and engagement activities, shows how specialist firms and technology can support this.
Right. Okay, now we arrive at the core, perhaps, investment management itself, managing the money day to day.
Yes. And the report clearly indicates expectations are high here. AI is expected to play an increasingly significant role, aiming for both greater efficiency and improved investment outcomes.
And plan sponsors expect this.
They do. Surveys show they anticipate seeing more AI used in portfolio management and risk management in the coming years.
Okay, let's break that down. Managing the actual investment portfolio. Where is AI being applied specifically?
Several areas. Portfolio construction, for one. AI and ML algorithms can analyze way more data points, more complex relationships than traditional models. They can incorporate things like investor sentiment data from news or social media to inform asset allocation.
So moving beyond just standard economic data.
Right. We're also seeing development in dynamic asset allocation strategies where the AI learns and adjusts the portfolio mix continuously based on changing market conditions, using techniques like reinforcement learning.
And actually buying and selling. Trade execution.
AI can optimize that too, analyzing transaction costs, predicting short-term price movements using ML techniques. This can help determine the best time and method to execute trades, minimizing market impact and costs. Techniques like deep reinforcement learning are being explored here.
And obviously managing risk is paramount.
Absolutely critical. AI can significantly improve forecasting, market risk, credit risk, by incorporating diverse data sources, news, company disclosures, even satellite imagery analyzing economic activity.
Wow, satellite imagery.
Yeah, using things like artificial neural networks to process all this information. This is especially important for DB plans managing their liabilities and for complex strategies like LDI, liability-driven investing. Meeting those long-term promises is key.
The report also mentioned alternative investments. That seems like a data challenge.
It really is. Private markets, private equity, real estate, infrastructure often lack standardized data. It's often buried in documents, reports.
Unstructured data.
Exactly. The APG example, the Dutch pension fund using an LLM-based digital assistant called Samuel for their real estate investments. That shows how AI can help extract valuable insights from that unstructured data, making it easier to analyze and manage these complex assets. Centralized databases built with AI assistance could be a big help.
And we can't ignore the big established platforms, right? Like BlackRock's Aladdin.
No, they're definitely integrating AI. Aladdin is using Gen AI, things like Aladdin Copilot, to provide real-time analytics and insights directly within the platform, helping portfolio managers ask questions in natural language, get quick answers, summarize research, all while keeping sensitive client data secure within the platform.
So making the existing tools smarter and faster.
Essentially, yes. Reducing time spent on data wrangling, freeing up humans for higher-level strategic thinking.
Sustainable investing came up again here, too. How's AI helping with ESG?
Well, ESG is crucial for long-term investors, like pension funds, but the data challenges are significant. Lack of standardization, subjective metrics.
Yeah, it can be messy.
They can. AI tools are being developed specifically to parse and analyze vast amounts of ESG-related data from different sources, company reports, news, NGO databases. The Phoenix Group example, using Neural Alpha's tech to assess human rights risks in supply chains using Gen AI. That's pretty advanced.
And reporting, like TCFD.
Yes. AI can also help streamline the data gathering and analysis needed for climate-related financial disclosures, TCFD reporting, which is becoming mandatory in more places.
Okay, one more within investment management. Robo-advisors. These have been around a while.
They have, and they're particularly relevant for DC plans. They use AI, primarily ML algorithms, to provide automated portfolio management and investment advice, usually at a lower cost than traditional human advisors.
What are the benefits?
Low costs, accessibility, personalized recommendations based on algorithms, and potentially less prone to some human emotional biases in investing.
Examples.
Lots out there. Betterment is known for tax optimization strategies. Elavis focuses on advice tailored for women. Wealthfront uses behavioral insights.
But there are caveats, right?
Definitely. The report stresses the need for rigorous testing, regulatory supervision, transparency, understanding how the robo makes decisions, its explainability. And importantly, they often work best when integrated into a broader strategy, perhaps with a human in the loop, for more complex situations or behavioral coaching. It's not necessarily an either with human advice.
Okay, let's move to the final stage,
Yeah.
the payout phase. Decumulation, when people start living off their savings.
Yeah, a really critical phase, and arguably one that needs more focus, especially in the DC world. It requires careful analysis, retiree behavior, market performance. Sequence of returns risk is a big one here.
That's the risk of bad returns early in retirement really damaging your prospect.
Exactly. It can deplete the capital too quickly. Predicting beneficiary behavior is also tough. What income level do they actually need or want? How long will they live?
How can AI help with these uncertainties?
Experience studies. AI can analyze historical data to improve predictions about when people might retire, or refine mortality forecasting using ML or deep learning techniques. This could allow for more frequent, more accurate updates to assumptions.
And predictive analytics for modeling future scenarios.
Yes, using AML to model thousands of potential future market paths, inflation scenarios, individual spending patterns, creating synthetic data to stress test strategies. The report even floats the idea of semi-automated actuarial processes in the future, with AI handling much of the modeling under human supervision.
What about specific products like annuities?
AI could lead to more sophisticated calculations for annuity pricing and features, potentially more personalized offerings. But again, checks for bias and fairness are absolutely essential here. AI assistance could also help explain how complex annuity products work to members.
The report seemed keen on linking saving and spending phases better in DC plans.
Yes, that's a key point. Currently, the accumulation saving phase and deaccumulation spending phase are often quite disconnected in DC. You build up a pot, then you're largely on your own figuring out how to draw it down.
Right.
AI has the potential to bridge that gap, enabling a more holistic, integrated retirement asset management strategy that supports members throughout their entire retirement journey.
Okay, the report had that visual. Exhibit 14, mapping AI tools to the big pension challenges. We can't see it, but can you give us the gist? How does AI help tackle things like underfunding, demographics, inflation, inequality?
Sure. So for underfunding, AI could help design personalized contribution strategies, nudging people to save more appropriately. For demographic shifts, enhanced predictive analytics give better insights for planning. For inflation, AI-driven tools can monitor risks more dynamically.
And inequality, financial literacy.
For inequality, bias detection algorithms can help ensure AI tools themselves aren't perpetuating biases, and AI could potentially help design more equitable plan features. For financial literacy, AI chatbots and personalized education tools can provide tailored guidance. And for personalization, AI can help craft tailored investment and decumulation strategies. It touches pretty much all the big challenges.
So as we wrap up this deep dive, what are the key takeaways, the main principles for pension funds, regulators, everyone involved, as they look to implement AI?
The report lays out a few crucial ones. First, balance personalization with simplicity. Not everyone is a finance expert, so solutions need to be accessible.
Yeah.
Second, collaboration is key. Solutions need input from pension funds, industry groups, tech providers, regulators. A multi-stakeholder approach.
Makes sense.
Third, use technology to build trust. AI should enhance human decision-making and transparency, not obscure it or replace judgment entirely.
Right. Augmentation, not replacement.
Exactly. And finally, set clear goals. How will you measure if AI is actually working? The focus has to be on improving the experiences and ultimately the retirement outcomes for beneficiaries.
So pulling it all together, what does this mean for you listening right now? It sounds like AI really does hold significant promise for tackling these huge, complex challenges facing pension systems worldwide.
It does. The potential is there to improve efficiency, personalize services, enhance investment returns, and manage risks better, ultimately leading perhaps to greater retirement security for individuals.
But it's not a magic bullet.
Definitely not. Responsible implementation is absolutely critical. That means careful human oversight, a relentless focus on building and maintaining member trust, fairness, transparency, and always keeping the long-term well-being of retirees is the primary goal.
A final thought for you then. Think about the different ways AI might start reshaping your own retirement journey in the coming years. It could be through more tailored advice you receive, perhaps more efficient management behind the scenes of your savings, or maybe even new types of investment strategies becoming available. This technology is poised to have a really significant impact.
It is.
We definitely encourage you to explore further the specific areas we've touched on today that caught your interest. Thanks for joining us for this deep dive.